Hello everyone, welcome to EduTap and welcome to Finance 360-degree session. So today we are going to discuss a very important press release of the Monetary Policy Committee of the Reserve Bank of India, and we are going to discuss a very important news article. Okay, so this is the Monetary Policy Committee meeting that has concluded in August 2025. Okay, yesterday only the Monetary Policy Committee meeting of August 2025 concluded, and there are various decisions, there are various important statements that we have to discuss, that has been discussed or that has been stated by the governor in the governor's statement, and the Monetary Policy Committee statement has also been released, so that we are going to discuss in today's session. Good morning everyone, welcome to the session. So the inflation is at 77-month low since 2019, the inflation. So we will see that what is the rate of inflation that is at 77-month low, as well as we will discuss the growth forecast for 2025-26 financial year. We will discuss the inflation forecast for the 2025-26 financial year. Okay, so the inflation forecast has been decreased further, so we will discuss that why it has happened and so. Okay, so this is going to be a very important session, as this is the recent Monetary Policy Committee meeting that has concluded. Yes, no change in repo rate, neutral stance, but there are the important data points that have been released in regards to the forecast, as well as in regards to the inflation rate that has gone 77-month low since 2019. This is the lowest inflation that we have seen. So we will discuss more about the data points, and this is directly important from your examination perspective, from the objective point of view for the phase 1 and phase 2 of the examination. Okay, and the points from this Monetary Policy Committee meeting you can also use in your descriptive answer writing if there is a question regarding the growth or the current situation or the current trend in the Indian economy. Okay, so such kind of questions, if they come, you can use the data points or the statements from this Monetary Policy Committee meeting. So let's get started without any delay, and do subscribe to the YouTube channel of EduTap if you have not done till now, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. So let's start with today's session. So first of all, Monetary Policy Statement, this is released for the meeting that was conducted from August 4th to August 6, 2025. So basically Monetary Policy Committee was held, this is the 56th meeting that was held for the Monetary Policy Committee, and this was held from August 4th till August 6th, 2025. So yesterday only the meeting has concluded. Okay, under the chairmanship of Shri Sanjay Malhotra, the Governor of the Reserve Bank of India. So all the 6 members were present in the meeting. Okay, all the 6 members of the Monetary Policy Committee, they were present in the meeting, as well as the Governor of the Reserve Bank of India, that is a member of the Monetary Policy Committee, was also present. Okay, now after assessing the current and evolving macroeconomic situation, the MPC has voted to maintain the policy repo rate at 5.5%. So I hope you remember that in February 2025 the repo rate was decreased by 0.25%. Then in April 2025 the repo rate was decreased by 0.25%. Now after the April, in June 2025 the repo rate was decreased by how much percentage? Anyone remembers? So the repo rate was decreased in June 2025 also by how much percentage? By 0.5%. 0.5%. So the repo rate was decreased from 6.5% to 5.5%. That is by 100 basis points, by 100 basis points, or by 1%, or we can say by 1%, the repo rate has decreased since February 2025. Okay, so in February 2025, this is very important because after a long time the repo rate was decreased in February 2025 by 0.25%. Then in April it was decreased by 0.25%, and then a big decision was taken to decrease the repo rate by 0.5%. That was done in June 2025. Okay, and so in total the repo rate has decreased from 6.5% to 5.5%, that is by 100 basis points. Now the MPC has decided that we have decreased the repo rate enough. Now we can maintain the repo rate at this low point, because see, the RBI was decreasing the repo rate so that the interest rate can decrease in the economy, because the interest rate in the economy is dependent upon the repo rate that is charged by the Reserve Bank of India. Okay, so if the repo rate is decreasing, so repo rate was decreased by the RBI, so that the interest rate can decrease in the economy. If the interest rate is decreasing in the economy, the people will take more loans at the lower interest rate. If the interest rate for home loans, for car loans are low, you can understand that at the lower interest rate, there will be more loans that will be taken. More loans means more money in the hands of the people and more demand in the economy. More demand, more loans people are taking, they are taking more money from the banks, so there is more money in the hands of the people, so they will demand more. If demand is increasing, the production, if the demand is increasing, the production will increase and the economic growth will be boosted. Okay, so RBI has taken the decision to reduce the repo rate from February 2025 till June 2025 to increase the demand, to boost the growth in the economy. Okay, now try to understand that whenever the repo rate is decreased, the interest rate starts decreasing in the economy, but there is a time that it takes. Okay, so there is a monetary policy transmission that happens. Okay, the RBI or the Monetary Policy Committee has taken the decision to decrease the repo rate. Now the transmission of the decision takes time. The interest rate, the decreasing interest rate in the economy, it takes time. Okay, so basically, if the RBI is decreasing the repo rate, the interest rate that decreases in the economy, it takes time. That is known as monetary policy transmission time. Okay, so monetary policy transmission, it takes time. The monetary policy decisions to be transmitted to the economy, this takes time. So if RBI is decreasing the repo rate, it's not like that in February the RBI has decreased the repo rate, so the interest rate will start decreasing from the next day onwards. No, it takes time. The policy transmission takes time. So if the RBI is decreasing the repo rate, the interest rate will start decreasing slowly in the economy. That's why the RBI has said that we have decreased the repo rate enough by 1%, by 100 basis points. Now let's see that how the monetary policy transmits to the economy, how much the interest rate decreases in the economy and how much the demand increases in the economy. So for now, the RBI is saying that we are going to look after the monetary policy transmission. Okay, because the transmission has started, the interest rate has started decreasing in the economy, but it is happening slowly, and the RBI wants to look that what the full transmission do. Okay, that is, if the interest rate is decreasing by the full rate, or if the interest rate decreases, how it will impact the demand, how much the demand increases, because when the demand is increasing, prices also start increasing. So RBI do not want the demand to increase too much, that will create a lot of inflation also. Okay, so the RBI is looking after the monetary policy transmission. This is the idea. So after assessing the current and evolving macroeconomic situation, the MPC has voted to maintain the policy rate at 5.5% only. That is just like in June 2025. In June 2025, the repo rate was decreased from 6% to 5.5%. Now in the August 2025, it has been decided that the repo rate will be kept at 5.5% because the RBI wants to see that how the monetary policy transmits to the economy, how much impact it creates on the growth and how much impact it creates on the inflation also. Now the repo rate is at 5.5%. The SDF rate is less than the repo rate by 0.25%. So the SDF rate is 5.25%. MSF rate and bank rate is higher than the repo rate by 0.25%. So basically MSF rate is higher than the repo rate by 0.25% and bank rate always aligns with the MSF rate. So if MSF rate is 5.75%, the bank rate is also 5.75%. This is the idea. Any confusion till now? So the decision is in consonance with the objective of achieving the medium-term inflation target of 4% plus minus 2%. So RBI wants the CPI inflation, the consumer price index inflation. This is the inflation that affects the consumer. This is known as retail inflation or headline inflation. This is the inflation that RBI targets or the Monetary Policy Committee targets. Okay, so CPI inflation is the retail inflation. This is the inflation affecting the consumers, affecting the consumer goods. So RBI targets or Monetary Policy Committee targets the CPI inflation. RBI wants, the Monetary Policy Committee wants the inflation to be around 4% in the range of plus minus 2%. Okay, so RBI wants the CPI inflation to be around 4% within the range of minus 2%, that is lower bound of 2%, and plus 2%, that is upper bound of 6%. So this is upper tolerance level. The inflation CPI, consumer price index inflation, should not go above 6%. The CPI inflation should not go below 2%. This is the idea. I hope everything is clear now. Now, coming to the global and inflation outlook. So, global environment continues to be challenging. Okay, global environment, we have just seen that how the US is reacting and how the US is just imposing the tariff. So, the global environment continues to be challenging, although the financial market volatility and geopolitical uncertainties have decreased to some extent, have reduced somewhat from their peaks in recent months. Trade negotiation challenges continues to linger because of the one power that is going out of hand, we can say. So trade negotiation challenges continue to linger. Global growth, though revised upwards by the IMF, remains muted. Okay, so global growth has been revised upward by the International Monetary Fund, but it is still muted. It is still not as high. It is not still as high as in the previous years. Okay, so basically this is the idea till now, that okay, the uncertainties have reduced to some extent because of the geopolitical scenario and the lesson of the market volatility, but still there are challenges that we are facing, or the world is facing. The pace of disinflation is slowing down. That means disinflation means decrease in inflation. So inflation rate, let's say at the global level, have come down from 9% to 8% to 7% to 6%. So the disinflation is slowing down. The decrease in the inflation rate is slowing down, with some advanced economies even witnessing an uptick in inflation, that is increase in the inflation rate. So disinflation is slowing down in various economies at the global level, with some advanced economies even witnessing an increase in inflation rate. So that is a problematic situation, because at the global level, if the inflation starts increasing, so whatever we import, let's say at the global level, the inflation is increasing, so that can come to India also through the supply chain effect. Okay, if the let's say we import toys from a particular country XYZ, now the toys prices are increasing in the country. So these toys that we are importing, their price is increasing, so the price in India will also start increasing, because we are importing the products at the higher price, or let's say we are importing the raw materials, and if their price also starts increasing, that will also lead to inflation in our country. So if the inflation increases at the global level, it might affect India also, if what we import is also affected, okay, with the higher prices. Basically now domestic growth remains resilient and is broadly evolving along the lines of our assessment, of the Monetary Policy Committee's assessment. So domestic growth is resilient. It is not affected by the challenges at the global level till now. Now, private consumption, that is the consumption of the households, of the individuals, is aided by the rural demand, which has increased in the recent time, and fixed investment. Fixed investment is supported by the optimistic or positive government capital expenditure. Government is doing the capital expenditure, government is building the flyovers, the government is building the roads, the government is building the tunnels and such. So government capital expenditure is positive, it is increasing, and that is increasing the fixed investment in the country. So this continue to boost economic activity. On the supply side, a steady southwest monsoon is supporting kharif sowing, replenishing the reservoir levels of the water, and boosting agriculture activity in the country. Moreover, services sector and construction activity remain robust. However, the growth in industrial sector remains subdued. This is the main problem, because the agriculture sector is faring well, it is doing well, the service sector is doing well, construction is also happening well, but the problem is in the growth in industrial sector, that remains subdued, that remained reduced and uneven across segments, pulled down by the electricity and mining segments. Okay. As for the growth outlook, the above normal southwest monsoon, lower inflation, rising capacity utilization. Capacity utilization means that the machineries, tools, the capacity that the industries have, they are being utilized at the optimum capacity, or they are being utilized at a higher capacity. So the machineries, tools, they are utilized at a rising capacity. So above normal southwest monsoon, lower inflation in the country, is rising capacity utilization of the machineries. Machineries are being utilized at a good level, at a rising level, and congenial financial conditions, good financial conditions continue to support domestic economic activity. Okay, the supportive monetary, regulatory and fiscal policies. RBI has decreased the repo rate from February 2025 till June 2025. RBI decreased the repo rate. The fiscal policy, the government is doing the government capital expenditure, that is boosting the fixed investment in the country. So the fiscal policies, including robust government capital expenditure, capital expenditure for the investment in the country, for the assets in the country should also boost demand. The services sector is expected to remain buoyant. It is expected to remain optimistic with sustained growth in construction and trade in the coming months. This is the idea. Any confusion here, anyone? Okay. Disinflation means that the inflation rate is decreasing, but it is positive. The inflation rate is decreasing, but it is positive. Deflation means that the inflation rate is negative. That means the general price level have started to decrease. Okay. So disinflation means that the inflation rate is positive. The prices are increasing, but by a slower pace. Okay. So general price level is increasing, but by a slower pace. So that is disinflation. Inflation is positive, but it is decreasing. Deflation means inflation is negative. The general price level has started to decrease. Okay, any other confusion? All clear. Next, coming prospects of external demand, however, remain uncertain amidst ongoing tariff announcements by the different countries and trade negotiations. The headwinds emanating from prolonged geopolitical tensions, there is persisting global uncertainties and volatility in the global financial market pose risk for the growth outlook. So basically the domestic conditions are good, the agriculture conditions are good, the service sector conditions are good, the industrial sector is subdued, but it is expected that the government will take step for the industrial sector also. But the main problem comes from the outside because of the trade negotiations or because of the tariff announcements. The trade negotiations are happening, but they are not as well placed, and headwinds are coming. The negative headwinds are coming because of the various factors from outside that is affecting the growth outlook. Taking all these factors into account, the projection for real GDP growth for 2025-26 has been retained at 6.5%. That means in June 2025 it was decided that for 2025-26 in June 2025 it was stated that for 2025-26 the growth projection is at 6.5% for the financial year 2025-26. Now this has been retained in August 2025 in the Monetary Policy Committee meeting. In August 2025 it has been said that for 2025-26 the growth projection is retained at 6.5%. That means the Indian economy is expected to grow at 6.5% in 2025-26 this financial year. Okay. Next is coming to this inflation scenario. So we have discussed about the growth scenario. Now coming to the inflation scenario. So CPI headline inflation declined for the 8th consecutive month. So CPI headline inflation or the retail inflation that we call it. So the retail inflation, that is the target for the Reserve Bank of India, that is the target for the Monetary Policy Committee. So retail inflation has declined, that is consumer inflation, we can say consumer price index inflation has declined for the 8th consecutive month to 77-month low of 2.1% in June 2025. This is lowest since Jan 2019. So this is the idea that we have come to the lowest of the inflation rate, and you can understand that we want the Monetary Policy Committee has to maintain the inflation around 4%. It should not go below 2%. It should not go above 6%. So basically we are near to the lower tolerance level, and this is a very good situation for now because we want the inflation to remain lower and we want the inflation to be around 3-4%, but it is around 2.1%. So that is a good news for our country because of the negative scenario in the global world. At least the inflation in our country is low. Okay, so we can take more steps for the growth in our country. So this was driven why this has happened, how the CPI inflation or the retail inflation has come down to such low point. So this is because of the sharp decline in food inflation led by improved agricultural activity and various supply side measures that were taken to smoothen out the supply chain effects. Okay, food inflation recorded its first negative print since February 2019 at negative 0.2%. So you can understand that the food inflation, it is like in the food category there is deflation that is happening. That means the prices in the food category have started to decrease. So there is a negative inflation, or we can say there is deflation in the food segment. Okay, so food inflation is negative, that means there is deflation in the food segment in June. Now high frequency price indicators, basically they refer to data that is available frequently, daily, weekly or monthly instead of quarterly or annually. So high frequency price indicators means high frequency price data that is easily available in the market. So basically, the high frequency price indicators signal a continuation of the lower price momentum in the food prices this year to July as well. That means in June, the food inflation has become negative. In the July, it is expected that this momentum will continue. This is the idea, okay? Yes. Now, next is core inflation. So what is core inflation? So basically, CPI inflation excluding food and fuel prices, that is volatile prices, okay? So CPI inflation excluding the food and fuel prices, that is the volatile prices. So this is the core inflation, that gives us the data for the manufactured products, for the industrial products and such, okay? So the core inflation is the CPI inflation excluding the food and fuel prices. So core inflation, which remained within a narrow range of 4.1% to 4.2% during February to May, increased to 4.4% in June, driven partly by a continued increase in gold prices. So basically, the core inflation is increasing because of the precious metals, because of the precious gemstones and metals, we can say. Because of this category, the core inflation is increasing because the gold prices are increasing, okay? Next is the inflation outlook for 2025-26 has become more benign. We have seen that in June, the inflation has come down to the lowest of the point since January 2019. So in June 2025, the inflation was as low as 2.1%. So it is said that for the 2025-26, for this whole financial year, the inflation outlook has become more benign, more considerate, we can say, than expected in the last Monetary Policy Committee meeting. Now, there is a large favorable base effect. What is the base effect? So basically, whenever the inflation is counted, we take the CPI inflation of the last year. So whenever inflation is counted on year basis, so let's say we want to see inflation in June 2025. So we will take the CPI data for June 2025, okay? And the CPI data for June 2024, because we want to see the year on year increase we want to see, okay? So basically, whenever you want to, this is basic mathematics, whenever you want to see the percentage increase, you take the new minus old divided by the old data, right? So the new data is the consumer price index for June 2025. The old data is consumer price index for June 2025, and the old data is consumer price index for June 2025, because you are comparing the inflation. You want the inflation rate on the year basis, okay, for June 2025. So let's say the new data is 110, the old is, or let's say the new data is 101, the old data is 100, the old data or the CPI in June 2024, old is June 2024, that is 100, okay? So it will be 1 upon 100, and we want to see the percentage, so multiplied by 100, so it will be 1%, okay? Basically whenever we want to see the inflation, year on year, we have to take the new data or the current data, and we have to take the old data and divide it by old data, and if we want to see percentage, multiply by 100. Now, if the base is high, the inflation rate will be high or low? Just tell me, if the base is high, the inflation will be high or low? That means if the consumer price index was high, that means inflation in a way was high in the previous year, so the inflation will be low in this year in comparison, because there is a favorable base effect, So this is the idea of the base effect. Whenever you hear about the base effect, always consider that we are talking about the denominator, the old value. If the old value is high, the new value or the percentage change will be shown as less, okay? So this is the basic idea. Yes, correct. So basically, the new data we have CPI June 2025. For the old data we have CPI June 2024. For the old data CPI June 2024. So basically, if the old value is high, so the inflation in the current period will be shown as lower. This is the idea. So there is favorable base effect, because last year the CPI value was very high in June 2024. Last year the inflation was very high in June 2024, and that's why we have a favorable base effect, as the base value is quite high. So we have a favorable base effect, okay? So large favorable base effects combined with steady progress of the southwest monsoon, healthy kharif sowing, adequate reservoir levels and comfortable buffer stocks of food grains have contributed to this moderation. Now CPI inflation however is likely to edge up above 4% by quarter 4 2025-26. So basically now it is saying that in the last quarter, that is from January 26 till March 2026, it is expected that the CPI inflation will go above 4%. This is going to happen because of the unfavorable base effects. Because what happened that in January 2025 till March 2025, especially in the Feb 2025 and March 2025, the inflation rate was very low. In the Feb 2025, in the March 2025, the inflation rate was very low, and the CPI, the Consumer Price Index for Feb 2025 or March 2025 was very low. So when we see the data for CPI Feb 2026 or March 2026, so basically the inflation rate will be higher because there is unfavorable base effect. Understanding, if the CPI for Feb 2025, March 2025 is low, if the consumer price index is low for Feb 2025 and March 2025, because in the Feb and March the inflation was very low. In the previous months the inflation has been very low in the Feb and March 2025. So if the CPI is very low in the Feb and March, so there is unfavorable base effect, so the inflation rate will be shown high in the Feb and March of 2026. So in the last quarter, in the fourth quarter of the financial year 2025-26, it is said that the CPI inflation however is likely to edge up above 4% because of the unfavorable base effects, because the inflation was low in Feb and March 2025 and demand side factors from policy actions come into play. So this is the basic idea. Next is bring any major negative shock to input prices, barring any major negative shock to input prices. It is said that if there is no negative shock that comes to the input prices, that comes to the raw material prices, core inflation is likely to remain moderately above 4%. So it is said that the core inflation is expected to be above 4% during the year. Weather related shocks pose risk to inflation outlook, and that's why, considering all the positive and negative factors, that we have the good southwest monsoon, we have the healthy kharif sowing, we have the good reservoir levels and the comfortable buffer stocks we have. So taking all the positive and the negative aspect, it is expected that the CPI inflation for 2025-26 is now projected at 3.1%. Now in June 2025, the CPI inflation projection for 2025-26 was given at 3.7%. That the CPI inflation is projected for this financial year, CPI inflation is projected at 3.7%. But now in August 2025, it is said that the CPI inflation for 2025-26 is projected at 3.1% for this financial year. So as per the Monetary Policy Committee meeting that happened recently, the inflation is projected, CPI inflation is projected at 3.1%. This is the idea. Now, rationale for monetary policy decision. So why the monetary policy decision has been taken to keep the repo rate constant? So we have discussed this, that MPC noted that the inflation outlook in the near term has become more benign, more comfortable, more optimistic, because it is expected that the CPI inflation will be 3.1%, 3.1% in the 2025-26. Okay, so that means the inflation is like around the 4% plus minus 2%. So inflation is within this range of 2% and 6%, and it is going to be around 4%. So basically the inflation projection has become more benign from earlier, and the average CPI inflation this year is expected to remain significantly below the target of 4%. So this is the idea. Okay, so basically last time when the projection happened for the CPI inflation was expected to be around 3.7%, but now the CPI inflation is expected to be around 3.1% in 2025-26. So now it is said that the CPI inflation is going to be lower than the target. So for the inflation, we have a good scenario that the inflation is going to be below the target. Okay, that is below 4% of the target. This is the idea. This is driven mainly by lower food inflation that entered deflationary territory. So basically the food inflation has become deflationary. The food inflation has decreased. It is like the food inflation has become negative, of negative 0.2%. So food inflation has become negative. It has come into the deflationary territory in June. However, CPI inflation is likely to edge up above 4% in the last quarter of the financial year 2025-26 because of the unfavorable base effect, as well as there is also the demand side factors from policy action. So basically the repo rate is decreased. So the interest rate will be decreased, and it is expected that the interest rate is decreasing slowly in the economy, and by the next year the whole transmission will finish, and by the January 2026, by January to March 2026, the whole transmission of the decreased interest rate will finish, and the interest rate will be very low in the later on part of the in the later on part, that is from August, let's say, the interest rate will be quite low in the economy, and there will be more loans will be taken. If more loans are taken, more demand will be conducted in the economy. With more demand, the prices will start increasing, and that's why also it is said that from January 26 till March 2026, the inflation is going to be high. Okay, so basically it is said that in the quarter 4, in the last quarter from January 2026 till March 2026, the inflation is expected to be above 4% because of the unfavorable base effect, because in February 2025, March 2025, the inflation was low. So compared to the low inflation in the Feb or March 2026, there might be high inflation that might be shown because of the low or unfavorable base effect. Okay, as well as because of the increased demand, with the repo rate being decreased and with the interest rate being decreased in the economy, with the monetary policy transmission, the demand will start increasing. With the lower interest rate, demand will start increasing and the prices will start increasing, and it will be higher. With the higher demand, the prices might be slightly higher in the Jan to March this quarter of the quarter 4 of financial year 2025-26. I hope this is clear. Moreover, the core inflation has been rising steadily from the recent low of 3.6% recorded during January 2024-25 and averaged 4.3% in quarter 1 of this year, that is from April to June 2025. The core inflation was averaged around 4.3%. Core excluding precious metals. So if we exclude the precious metals, from the core inflation, then the core inflation has witnessed an uptick and averaged of 3.4% in quarter 1 in this quarter. So growth has held up with some pickup expected in the coming festive season, with the Diwali coming up, with the Dasara coming up, Navratri coming up and such. So with the festive season, there is the pickup that is expected in demand and growth. So that's why it is said that the real GDP will grow around 6.5% in 2025-26. Thus, while headline inflation is much lower than the projected earlier, it is mainly due to volatile food prices, especially of vegetables. Core inflation, on the other hand, has remained steady around 4%. That was anticipated. Okay. Now, next is growth is robust, and as per earlier projections, though below our aspiration, we want the growth to be around 7%, 8%, but the growth we are expecting it to be around 6.5%. Okay, so monetary policy transmission is continuing. As I have told you that the monetary policy transmission has not finished. The repo rate has been decreased since February 2025. The repo rate has been decreased, but the interest rate takes time to decrease in the economy. And with the decreased interest rate, it's not like that, okay, today the interest rate has decreased, tomorrow 100 people will line up to take loan. No, people will understand that, okay, interest rate is decreasing, now we should take the loans. So the loans will increase slowly and slowly, and so demand will increase slowly and slowly, and it is expected that the whole transmission of monetary policy might end around the start of the next year. Okay, that is the quarter 4 of the financial year 2025-26, that is January to March 2026. Okay, so this is the idea. On balance thereof, the current macroeconomic condition outlook and uncertainties call for continuation of the policy repo rate at 5.5%. So it is said that we have already decreased the repo rate by a lot. So now for now we are going to see that how the monetary policy transmits completely. Okay, of the front loaded rate cut. Front loaded rate cut means that already a lot of rate cut has happened. So we will see that how the monetary policy transmits in the credit market and the broader economy. So the MPC has unanimously voted to keep the repo rate unchanged. The MPC further resolved to maintain a close vision on the incoming data on the evolving domestic growth inflation dynamics, and accordingly it also has decided that the monetary policy stance will be neutral. Neutral stance means that the repo rate might be increased if the RBI thinks that suddenly, because of the tariffs, because of the global situation, the inflation is increasing, so RBI might increase the repo rate, or RBI can decrease the repo rate to boost the growth. So if inflation increases in the economy, the RBI might decide to increase the repo rate to control the inflation. If the RBI wants to boost the growth further in the economy, RBI might decrease the repo rate. This is the idea, okay? So this is the idea. Any confusion? Neutral stance means the repo rate might be increased, the repo rate might be decreased. If the inflation increases, to control the inflation, repo rate will be increased. To control the inflation, the repo rate will be increased, and to boost the growth, repo rate can be decreased. Okay, this is the idea. Any confusion? Ujjwal, I am not aware about this. You can comment in the comment section below, or you can mail at hello@edutap.co.in. So Ujjwal, do mail at hello@edutap.co.in if you have any question regarding the enforcement officer. I'm not so much aware about it, so you can mail here, okay? Any confusion? Neutral stance always means that the repo rate can be increased or the repo rate can be decreased. And I hope you have studied the static part. So repo rate is increased to control the inflation in the country, and the repo rate is decreased to boost the growth in the country, okay? This is the idea. So neutral stance is taken for now. Now here, the last part is that the repo rate was last increased, like repo rate started to increase from May 2022, and the repo rate was continuously increased till February 2023. From February 2023 till February 2025, the repo rate was kept at 6.5%, or we can say from February 2023 till December 2024, the repo rate was kept at 6.5%. In February 2025, the repo rate was first decreased by 0.25%. So in February 2025, the repo rate was decreased by 25 basis points, that is by 0.25%. Then in April 2025, the repo rate was further decreased by 0.25%, and in June 2025, the repo rate was decreased by 0.5%. This is the idea, okay? So this is the table. You always have to remember the previous data in regards to the Monetary Policy Committee. The history, you have to remember that for like in May 2022, the repo rate was increased for the first time after a long period of time, and then in February 2023 till then the repo rate was increased. From February 2023 onwards till December 2024, the repo rate was kept at 6.5%. Then in February 2025, the repo rate has started to decrease till June 2025. This is the idea. So MPC unanimously decided to keep the repo rate unchanged at 5.5%. GDP growth projection for financial year 26 is retained at 6.5%. Governor says domestic growth remains resilient, broadly evolving. Inflation forecast for financial year 2025-26 has lowered to 3.1% from 3.7% of the forecast that was given in June 2025. The current account deficit expected to remain within sustainable level, and monetary policy transmission is still on. As I've told you that it has not completed, it is still on. Monetary policy, the decrease in the repo rate that was done in the previous Monetary Policy Committee meetings, so that is still transmitting to economy, that is interest rate is still decreasing, and the people are still like getting aware about it. Now, impact of 100 basis point of rate cut since February 2025 on the economy is still unfolding, and that's why the RBI has decided to not decrease the repo rate further, to first see that how the situation comes out. Okay, this is the idea. Now, try to answer the first question. Does neutral stance means dovish? No, dovish means accommodative or expansionary. Hawkish means contractionary. Okay, dovish means dove-like. That is very like what do we say? Accommodative, and that is looking after the economy from the growth perspective. Okay, that is dovish. Yes, dovish is like accommodative or expansionary, where the growth is the focus area. Okay, so this is the first question. I hope you will be easily able to answer this question. Now this is the second question, where you have to tell that which of the following statement is or are correct. Okay, You have to tell that which of the following statement is or are correct here. So this is it. And let me tell you that there is a perspective 360-degree series that is there from Monday, Wednesday and Friday. You can see it at 5 p.m. So perspective 360-degree series that is taken by Jaskaran sir. This is for your answer writing practice that is taken on Monday, Wednesday and Friday at 5 p.m. So you can see that series, you can see the sessions, and you can know that what are the hot topics right now from where the descriptive questions can come. As well as in the series there is also the questions that are given on homework, and if you write the answers in the comment section, they also get evaluated by the team. So this is a very good way to practice the questions and the hot topics that are quite in use from where the descriptive questions can come. Okay, so this is it for today. Okay, so this is it. Thank you very much for joining the session. See you in the next session. Okay, so have a good day everyone. Thank you everyone. Ma'am, how is the tariff imposed by US impact Indian economy? Because see, if the US is basically, if the US is like imposing import tariff, that means the Indian products will become expensive for the US citizens, and that's why the US citizens will demand less of the Indian products. If they demand less of the Indian products, that means the export from India to US will decrease. And if the exports are decreasing from our country, that means exporters will be affected. That means the total production will be affected and it might decrease. Okay, but till now, what impact it will create, that we will know in the long run when actually things unfold. Maybe the US citizens might not decrease the demand, depends upon the different factors. Okay. Okay, so the Telegram group, the link for the Telegram group is given. The link for the Telegram group is given in the description box below. You can just go in the description box below and you can click on the link for the Telegram group and join.